It wasn't a sudden return of retail mania. It wasn't a speculative frenzy driven by social media hype. It wasn't even a reaction to a specific geopolitical shock. It was a structural alarm. When an ancient monetary metal and a digital bearer asset surge in tandem, the signal is unambiguous. The arithmetic is merciless. We are witnessing the mechanical response to a sovereign debt trap, a trap worth $35 trillion and growing. Most observers agree that asset prices fluctuate based on earnings or innovation. But at the end of a long-term debt cycle, prices move based on liquidity and the debasement required to sustain it. The pattern is unmistakable. History provides a clear roadmap of what happens when a hegemon can no longer afford its own dominance. The sequence never varies. It begins with dominance. It ends with a desperate flight to hard assets. To understand why Bitcoin and silver are moving now, we must look at the three specific moments in history where this exact mechanism played out. The first clear instance occurred in the Roman Empire, specifically during the crisis of the 3rd century. But the seeds were sown much earlier. Under Emperor Nero in 64 AD, the Roman state faced a fiscal wall. The cost of the army, the bureaucracy, and the grain dole exceeded tax revenue. Raising taxes was politically impossible. Cutting spending was dangerous. So Nero chose the third option, the monetary shortcut. He reduced the silver purity of the denarius from 100% to roughly 90%. It seemed like a cost-free solution. The soldiers were paid. The games continued. But the incentive structure had changed over the next centuries. Subsequent emperors repeated the trick. By the time of the crisis of the 3rd century, around to 60 AD, the silver content of the currency had collapsed to less than 5%. The resulting inflation was catastrophic. Prices for wheat and labor skyrocketed. But here is the crucial detail. The citizens did not just sit and watch their wealth evaporate. They engaged in a massive flight to reality. Wealthy Romans and commoners alike dumped the debased coinage. They bought land. They bought gold. They bought raw commodities. The middle class was hollowed out. Society fractured into those who owned real assets and those who held the melting currency. The empire survived in name, but the economy was fundamentally broken. Just like the Roman debasement, the Weimar Republic in early 20th century Germany faced an unpayable bill. The year was 1921. Germany was burdened with massive war reparations demanded by the Treaty of Versailles. The industrial output of the nation had been shattered. The tax base was decimated. The government faced a binary choice: default on the foreign debt and face occupation, or print the marks to buy the foreign currency needed to pay the bill. They chose the printer. The result is well documented in history books, but the behavioral response is often overlooked. By 1923, the inflation was vertical. But before the currency went to zero, there was a frantic flight from the mark. Ordinary Germans realized the money was broken. They rushed to exchange paper for anything tangible. Factory workers were paid twice a day so they could rush to the shops. They bought antiques. They bought pianos. They bought scrap metal. They bought foreign currencies like the US dollar and the British pound. The stock market in nominal terms soared to astronomical highs, creating an illusion of wealth. But in real terms, the purchasing power of the middle class was annihilated. The flight to hard assets was the only lifeboat. Those who held paper were wiped out. Those who held tangible goods survived. Just like the Weimar collapse, the modern tragedy of Venezuela illustrates the endgame of the cycle. Starting around 2013, following the death of Hugo Chavez and the collapse of oil prices, the Venezuelan state found itself with a massive fiscal deficit. Social programs had been funded by high oil revenues. When that revenue dried up, the government of Nicolas Maduro turned to the central bank. They began monetizing the deficit on a massive scale. The bolivar lost its value at a terrifying speed. Estimates range, but inflation eventually hit millions of percent once again. The human reaction was a desperate search for store of value. Venezuelans did not wait for official announcements. The incentive was survival. They utilized any vehicle possible to escape the local currency. They bought dollars on the black market. They bought gold flakes in the mining regions. And significantly, They became one of the earliest populations to adopt Bitcoin at a grassroots level, not for speculation, but for preservation. The digital asset provided a way to bypass the crumbling banking system and capital controls. The mechanism was identical to Rome and Weimar, only the technology had changed. The pattern repeats in 7 distinct stages. Stage 1 is the commitment. The government commits to obligations, war, welfare, or infrastructure that exceed its ability to tax. Stage 2 is the deficit. The gap between revenue and spending widens, and the state borrows to fill the hole. Stage 3 is the repression. As debt levels rise, interest payments become painful. The central bank intervenes to keep rates artificially low, punishing savers to fund the state. Stage 4 is the debasement. The central bank begins to monetize the debt directly or indirectly, expanding the money supply faster than the economy grows. Stage 5 is the recognition. The astute capital of the smart money sees the arithmetic. They realize that debt cannot be paid back in real terms. Stage 6 is the flight. This is the stage where we see the surge in hard assets. Capital flees the sovereign bond market and the currency, seeking refuge in gold, silver, land. And now, decentralized digital assets. Stage 7 is the reset. The system becomes dysfunctional. A new monetary standard is introduced, often involving a currency devaluation or a rate denomination, just like the flight from the market. 1923, current data suggests we are entering Stage 6. The signals are flashing red. Gold is reaching all-time highs in almost every fiat currency. Silver is waking up from a long slumber, and Bitcoin has rebounded aggressively. The counterargument is often that the US dollar is strengthening against other currencies. Critics point to the DXY index and say there is no crisis. But this misses the point. The dollar is merely the cleanest shirt in the dirty laundry. The flight is not from the dollar to the euro. It is a flight from all fiat obligations into neutral assets. The incentive is driven by the fiscal situation of the United States, with debt exceeding $35 trillion and interest payments on that debt now costing more than the entire defense budget. The market is pricing in the inevitability of further debasement. The Federal Reserve cannot keep rates high enough to fight inflation without bankrupting the Treasury, and it cannot lower rates without reigniting inflation. Under these constraints, the rational move for large pools of capital is to hedge. History suggests 3 potential endgames. The first is controlled decline. This is often called financial repression. We saw this in the post-World War II era. Governments keep interest rates below the rate of inflation for a decade or more. This slowly liquidates the real value of the debt. Bondholders lose purchasing power year after year, while hard assets generally appreciate. The second endgame is chaotic collapse. This resembles the Weimar or Zimbabwe scenario. Confidence is lost suddenly. The currency enters a hyperinflationary spiral, and the economy ceases to function until a hard reset occurs. The third endgame is a structured reset. This is akin to the 1944 Bretton Woods Agreement or the 1971 Nixon shock. Powers converge to rewrite the rules of the global monetary system, usually pegging currencies to a new basket of commodities or a new reserve asset. In all 3 scenarios, the holder of paper currency is the designated loser. The holder of hard assets is the survivor. The only variable is timing and pain. Subscribe to the channel to track these signals as they evolve. Educate yourself on the history of money. Build resilience in your personal economy and pay attention to the data, not the headlines.